What's up, everybody? Welcome to my first ever YouTube video. This is going to be a very interesting video as we're going to be discussing why Uber is going to demolish earnings. So for those of you that don't know, Uber is going to be reporting earnings right about here, November 5th. Their last earnings, they were estimated to be 0.31 EPS, and it was actually 47 cents. So I went ahead and looked at the previous results, right? And because I do have Uber, and I was disappointed a couple earnings ago, right about here. I mean, it went down a lot, almost 20% in that little time frame there. So I bought it after this. I bought it about here, I want to say. So I'm not up too much, up a few percent, but I wanted to look into their earnings report just to see what was going down. And I was looking at this, their net income. It was $1 billion, right? You can see it was $1 billion. But then I read, which includes a $333 million benefit pre-tax due to net unrealized gains related to the reevaluation of Uber's equity investments, which basically means money they gained on stocks. So companies they invested in went up in value. As we can see right here, this is their income, other income, okay? Unrealized gain or loss on debt and equity. As you can see, 3 months ended for the second quarter. Second quarter in 2024, $333 million they made. And it breaks it down. So 466 million on Aurora, 151 million on Jobby, 225 million on Grab, $461 million loss on Didi. So you can see that they made a lot of money. This is one third. A third of 1 billion is 333.33333.3 million. That's one third just from stock gains. So that affected their earnings so much. So this estimate was actually spot on. However, they made $333 million off of stocks. Uber would not certainly not have gone up, what's this? 35% if they hit expected earnings or just beat. They certainly would not have gone up that much. So I just know that other income they made from the investments helps so much, so much. So I went to their 10Q, which is just their quarterly report to the SEC, and it tells me how much they own of each one of these, right? So Didi, they have 2.3 billion, Grab 903 million, Aurora 342 million. So I wanted to take a look. So this was from the previous quarter, tells you kind of the movement, and then I wanted to look for the next quarter. So I did some math about their total gains. They own 536 million shares of Grab, 529 million of Didi, and 321 million of Aurora. Their gain off each was significant. On Grab, they made 123 million. On Didi, 132 million. On Aurora, 1.18 billion. That puts them at a total gain of 1.435 billion dollars just from stocks alone. So they're only predicted to make about $740 million. They're only predicted to make about $740 million. They're going to make more than that for sure off their operations because Q3 is better than Q2. Now, there's a few things that could affect this earnings report negatively. So, one could be, you know, if it had bad earnings. We know earnings are going to be good, okay? And the second most is the guidance. So the future guidance. So if a company is doing well, they beat earnings, but they say, hey, income's going to go down next quarter. It's actually going to go down. Like the stock's going to fall. Q4 is However, Q4 is historically the best quarter. So their forward-looking guidance is going to say revenue estimates are going to go up, quarterly estimates are going to go up. It's it's going to have fantastic forward-looking guidance because Q4 is historically good, and The general earnings report is going to be amazing. Operational income is going to go up because Q3 is better than Q2. We know this. Operational income is going to go up because Q3 is better than Q2. Q4 is historically the best, so positive outlook, positive guidance. This is a no-brainer. Okay, well, that's all you got from me, so bye-bye.